Hello, class. We're back. We're in a covered chapter 3 now. Bear with me for a second while I get things set up. All right. So, in the last chapter, we did a review of accounting, as I mentioned, and one of the reasons that we are reviewing some of the information that you covered in accounting is just because in finance, we're really going to be utilizing some of the data that is developed through accounting and through financial statements in order to develop our analysis. So, well, why are we using accounting data? The truth is that's because that's what we have. That's what's available. Um, so in this chapter, we're going to talk more about the financial statements themselves, and we'll discuss a little bit about ratios, which again I know that you covered in accounting, um, but we'll talk about them potentially in a little bit of a different light as we move forward here. Um, but what I really want you to think of as far as the ratios go right now is where you can spot red flags. How is a company doing? You know, are they doing well in a certain area, but are they really doing poorly in a particular area? And ratios can help kind of uh, point to that. Okay, so let's go through some of the key concepts and skills from this chapter. We're going to want to know how to standardize financial statements for comparison purposes. I don't know if you did that in accounting or not, but that might be something new that we discuss here. We want to know how to compute and interpret important financial ratios. We'll want to discuss the determinants of a firm's profitability and growth. And really, we want to understand the problems and pitfalls of financial statement analysis. So our chapter outline looks like this, where we're going to talk about standardized financial statements to start out the chapter. We'll discuss ratio analysis, may get into the DuPont identity, internal and sustainable growth, and using financial statement information. So let's start. The old the old textbook had, and I assume yours may still have, an example where they were comparing Toyota, GM, and Ford. And the truth is, you know, when you have organizations like that, Toyota, GM, and Ford, for example, it can be problematic because the levels are so different between those firms. Um, you know, certain firms are much bigger than others. Um, you know, that sort of thing. The good thing about um, standardized financial statements is they allow users to compare companies of different sizes and compare companies as they go through time. Common side balance sheets are one example here, where you can have all accounts as a percentage of your total assets. Common size income statements are all line items as a percentage of sales or revenue. And then standardized statements they're just useful for comparing financial information from year to year, comparing companies of different sizes, particularly within the same industry. So common size statements, they're basically standard financial statements presenting all terms in a percentage. So for balance sheets, percentage of assets, income statements, percentage of sales. The old text had an example of Proofrock Corporation. You can see here you're looking at a balance sheet, and you can see the information from 2009 and then into 2010. When you look at it in terms of straight numbers, I don't know. I don't know how you feel about it, but I don't feel as though it tells me as much as this does. The common size balance sheet, where you really get an idea of percentages. The common size balance sheet gives you a percentage of total assets. So you might have a better perspective on things and how things are changing. For example, it's pretty evident that just from real quick glance here, cash increased from 2009 to 2010. And you can actually go about looking at the change in that. And you know, if you go through some of the things, if you just look at the change column, you can see that long-term debt significantly declined and retained earnings significantly rose. And, a lot of people would think that that might be a good thing. So, you can kind of get a real good analysis gauge by looking at common size balance sheets and financial statements in general. Speaking of that, we're going to move on to the income statement. Here's a typical income statement in terms of numerical values. And then if we put it in terms of percentage of sales, you may be able to gain a little bit more information. Another way to avoid problems with comparisons is to utilize ratio analysis. This allows for better comparisons through time or between companies, and these are used both internally and externally. The truth is, on their own, statistics are hard to categorize as good or bad. You really need a comparison in order to kind of gauge whether it's good or bad. So ratio analysis allows you to do that. For each ratio, we're going to be asking ourselves what the ratio is trying to measure and why that information is important. You should also be thinking about what is the unit of measurement and what are the benchmarks used for these components. So if we walk through some of these ratios here, let's start with liquidity ratios. There's 5 real kind of categories that we're going to discuss. The first is liquidity ratios, which some people call short-term solvency ratios. And these are going to measure a firm's ability to pay bills in the short run. Financial leverage ratios or long-term solvency ratios are going to test the firm's ability to meet long-term obligations. Asset management or turnover ratios are going to see how efficient assets are being utilized by the firm. Profitability ratios are going to measure how efficient a firm operates and how that translates to the bottom line. And then finally, market value ratios are going to test how the market views the firm, kind of a forest through the trees approach there. So this table really presents a real big overview of all the things that we're about to discuss in terms of ratios and how they're going to be computed. I want to stress that our class is not meant to make you memorize these sorts of formulas, but what our class is meant to do is kind of give you an idea of why they're important. So the reason I think that what you can get out of this class is really the 1, 2, 3, 4, and 5. What we're really looking at here, we're looking at short-term solvency, we're looking at long-term solvency, we're looking at asset utilization, and we're looking at profitability and then market value. So we have different ways of doing that, and all these ratios are going to kind of fit into those categories. So let's start out with our liquidity ratios, which are looking at your short-term obligations. Your current ratio, which is your current assets over your current liabilities, should be greater than 1. The higher, the better. Quick ratio is your current assets less your inventory over your current liabilities. It's also known as the asset test. Asset test for many companies is less than 1. The inventory is excluded in that ratio. Basically, these types of ratios, current ratio, quick ratio, or cash ratio, tell us the ability to pay bills quickly. Financial leverage ratios are going to measure the level of indebtedness or debt capacity, the ability to service debt, or the likelihood of default. So we have a couple ratios here. The total debt ratio, you're looking at your total assets and your total less your total equity over your total assets. Basically, this here for this particular firm means that they have 28 cents of debt for every $1 in assets. Your debt to equity ratio is another thing you could look at to look at financial leverage, and your equity multiplier as well, another ratio that could be important here, where you're looking at your total assets over your total equity, or alternatively, 1 plus your debt over equity. There's more financial leverage ratios here, as you can see, times interest earned. You look at your EBIT over your interest, the cash coverage, which is your EBIT plus the depreciation over your interest. Times interest earned is really measuring how well a company covers its interest. Cash coverage is factoring in the depreciation into that element. So we've looked at two now. Let's look at the third one, the asset management type ratios. Here we're looking at inventory. Um, Asset management ratios are also called asset utilization ratios. And really they're measuring how well a firm is using its assets to generate sales. Inventory turnover is a good one. Cost of goods sold over inventory is the ratio there. The higher the better. Days sales in inventory, the lower the better. As you can see here, that's 365 over your inventory turnover. As far as your asset management receivable ratios, you see here you have a receivables turnover, which is your sales over your accounts receivable. Again, the higher the better. Days sales and receivables, the lower the better. Cash is collected on sales in fewer days, if that's the case. And then finally, your asset management asset turnover ratios, which you can see total asset turnover. This is saying for this particular company, for every $1 in assets, the firm is generating 64 cents in sales. Less than one is not necessarily a problem for most firms. You can also see they have the capital intensity ratio there listed as well. I think point 4 here in terms of categories was profitability. Um, this is probably the best known and most widely used of these ratios. Um, Going back, you have your profit margin, which is looking at operating efficiency, earnings per $1 of sales, and obviously the higher the better. You have your return on assets, which is also known as return on investment. There's a few ways to compute. Just be sure to use the same technique as the benchmark that you're comparing to. And then you have your return on equity, which is always going to be greater than the return on investment or the return on assets as long as the firm has debt. And of course, that's going to be the higher the better as well. And then the final fifth kind of category is the market value measures. Um, Really here we're looking at, like the PE ratio and that sort of thing, market to book ratio. And they're kind of showing you how to calculate it via the market price. They have the 88 bucks per share for this. Shares outstanding 33 million. So you can calculate your earnings per share, for example, just by taking your earnings, which is 363 over your 33 million, and get it 11 bucks, or your PE ratio, which is your 88 over your 11, which is going to get you 8 times. Your price to sales ratio, which is looking at your $88 over 23.11 divided by that 33 from your shares outstanding. And then you have your market to book ratio, which is your price per share over the book value per share. And the book value per share is calculated as your total equity, which is $2,591 over your 33 million shares outstanding, which is going to get you the 78.52. Whereas the market to book is going to be your 88 over that 78.52, which is 1.12 times. And basically this is saying the value of less than 1 may indicate that the firm is not successful in creating value for its shareholders. And of course, in this example, it's above 1, so that's not necessarily the case. Summarize all the ratios that we just went through. This is a good kind of summary of all the ratios that we just calculated or went through. Now the text does go through an example. I don't know if it's the same example, probably isn't the same example here, but at the time it was going through Lowe's versus Home Depot, and you could see that the sales are very different. Home Depot is a lot more sales, but you can look at the different ratios to kind of gauge how the firm is doing relative to a competitor. And in a lot of cases, you can get a really good foundation of where you think a better investment may be in terms of looking at these different variables. So sometimes I actually stop here, but I would like to kind of continue if possible, um, talking a little bit about the DuPont identity. And one way to calculate return on equity is to utilize the DuPont identity. So the basic ROE formula is net income over total equity. But an alternative is to look at uh, your profit margin, uh, total asset turnover, and your equity multiplier. And you can see how to calculate each of those variables here in this equation. Your profit margin is your net income over sales. Your total asset turnover is your sales over total assets. And then your total assets over total equity is going to give you your equity multiplier. And it should equal your net income over total equity. Um, Again, it breaks it down into three pieces, and the real reason for this is to investigate what areas really need improvement for your organization. So the profit margin is going to measure the firm's operating efficiency and how well it does in controlling its costs. Total asset turnover is going to measure the firm's asset use efficiency and how well it does to manage its assets. And then, of course, the equity multiplier is going to measure the firm's financial leverage. So you could easily calculate this from existing data, which the text does here. You can take your profit margin, your total asset turnover, and your equity multiplier, multiply them all together, and you get your ROE here, which you can see is going to be 14%. The text goes on to talk about internal and sustainable growth, payout and retention ratios. To give you an example, the dividend payout ratio, how much should you pay out in terms of your dividends, which they classify as the B variable here. So they look at dividends per share over your equity per share. Alternatively, cash dividends over net income. And the retention ratio is one less that B variable, where you're looking at your equities per share less your dividends per share over your equity per share. And you consider this addition to retained earnings over net income. So really, firm's net income is going to be divided into dividends and, of course, retained earnings. So you're either going to think about it this way: take yourself out of all this detail and think about it. If you are an organization that is a corporation, you're either going to have to reward your shareholders via dividends, or you're going to have to reinvest that money back into the firm via retained earnings. And that's what this is really kind of classifying, that net income is going to be divided into those areas, either dividends or retained earnings. For Proofrock, they're calculating how you could actually calculate the dividend payout ratio, looking at the cash dividends over your net income. And they also show the retention ratio, looking at addition to retained earnings over your net income. I do want to specify that I think one of the homework questions talks about a plowback ratio, and when they're talking about the plowback ratio, they are referring to that 1 minus B. So where B is your dividends over your net income. So alternatively, the 1 minus B would be 1 minus dividends over net income. That's a hint for your, if you do have a homework problem that's similar to that. As far as internal growth rate, a firm's ROA and its ROE are used to calculate two numbers that deal with a firm's ability to grow. It can kind of grow from within, and this is saying how much a firm can grow assets using only its retained earnings, and this is the formula to do that. So just think about it only using internal funds for growth. And as you can see here, the answer would be 7.23. How much the firm can grow using internal generated funds and issuing debt is different. And this is called the sustainable growth rate. And I think this is one that you have a homework question on. Some firms have a particular debt ratio or equity multiplier they view as optimal. So they may want to hold it to constant. And if that's the case, you can kind of use this formula to calculate that. And as you can see, it was 10.29, a little higher than the internal growth rate. As far as the determinants of growth, of course, the profit margin was one of the variables involved, and that's going to be measuring your operating efficiency. Total asset turnover is going to be measuring your asset use efficiency. And then you have your financial leverage, the choice of the optimal debt ratio, and then dividend policy, choice of how much to pay shareholders versus reinvesting in the firm. A lot of things to consider for an organization in order to grow. So, I mean, you could look at different organizations in terms of their DuPont analysis. So, why are we going to be evaluating financial statements at all? Well, there's internal uses. We can utilize financial statements to evaluate our own performance in terms of compensation and comparing between different divisions, planning for the future, guiding and estimate future cash flows, that sort of thing. But also, there's external uses like creditors, granting credit to new customers, evaluating suppliers, customers, stockholders, that sort of thing. And of course, probably one of the main aspects is just benchmarking. Ratios are good for allowing us to compare our organization to someone else. It also allows us to look over time and see if we're improving in certain areas or worsening. So there's both internal and external uses. As far as peer groups go, you should try to compare to similar companies within industries. SIC and NAICS codes will help with that, and I want to star this point here for long term with your capstone, that if you get into a specific area, make sure that you know what SIC and NAICS codes are, because that will help you with your benchmarking when you compare your financial ratios to some sort of industry conglomerate or a couple competitors, that sort of thing. So what are some of the problems with financial analysis? Well, sometimes you have conglomerates like GE, for example, which it's such a interesting company because it goes into so many different areas. There's really no available comparables. Other times, there's global competitors that aren't necessarily included in your analysis. Sometimes, especially with global competitors, there could be different accounting procedures, different fiscal year ends, depending on what you're talking about. Differences in capital structure. Some firms might be more exposed to debt, others may be less. And then, of course, seasonal variations and one-time events. So a lot of these things can be problematic when trying to gauge one firm's performance relative to others. I think that's it. I'll see you soon.